Did you know that when you buy the S&P 500, nearly 30 cents of every dollar goes into just 10 companies? In the previous video I explained that an ETF is not an asset class, but simply a container that holds other assets. The real investment risk always comes from what is inside that container. In this video, I will open the basket and look inside two well-known ETFs, the S&P 500 and the Nasdaq-100, in order to show what investors actually own when they buy them. Before I get started, keep in mind that an ETF follows the holdings of an index. So, there are multiple ETFs that follow that same index, with different fees, ticker symbols, and so on. Let's start with one of the most widely used ETFs in the world, the S&P 500 ETF, ticker symbol VU. This ETF tracks the S&P 500 index and holds roughly 500 of the largest companies in the USA. Many investors think this means equal diversification across hundreds of companies, but that is not how the index works. The S&P 500 is market cap weighted. That means that the largest companies receive the largest weight in the fund. The information technology sector takes 33.4%. Financials a close second with almost 13%. However, if we look at the top holdings, companies such as Nvidia, Apple, and Microsoft dominate the portfolio. The top 10 holdings take up around 38% of the entire ETF. Some investors point out that the concentration of the largest companies in the S&P 500 reduces diversification. However, there is another perspective. The companies that dominate the index today generate enormous amounts of cash and profits. In many cases, they are among the most financially robust companies in the global economy, operating in sectors with a very high barrier to entry as well. Meanwhile, the smallest companies in the index often contribute very little to the overall returns, and some of them even struggle with profitability. So while the index is concentrated at the top, those companies are also responsible for a large share of the market's earnings and growth. Now let's compare that with another popular ETF, the Invesco QQQ ETF. The QQQ tracks the Nasdaq-100 index, which contains 100 of the largest non-financial companies listed on the Nasdaq exchange. Because many technology firms are listed on the Nasdaq, the index naturally has a very large exposure to the technology sector. If we look at the sector allocation, technology companies represent the majority of the fund, almost 60%. The largest holdings are once again Nvidia, Apple, Microsoft, and so on. Basically, firms that sit at the center of modern digital infrastructure and artificial intelligence. The top 10 holdings represent almost 47% of the entire ETF. As a result, the performance of the QQQ is closely tied to the growth and profitability of the technology industry. For investors, especially in contrast with the S&P, this means that owning the QQQ is not simply buying a slice of the overall economy. It is gaining strong exposure to one of the most dynamic sectors in the market. When evaluating an ETF, investors should always look at several key characteristics. First, examine the top holdings to understand which companies dominate the portfolio. Second, check the weighing methodology to see how the index allocates capital. Third, review sector exposure in order to understand which industries drive the returns. Fourth, check geographic exposure to see where the companies operate. And finally, you should always consider the expense ratio, the cost of owning the ETF. Usually it is around 0.2% per annum. An ETF is only the wrapper. The real investment is always the underlying assets. Two ETFs can look similar on the surface, but expose investors to completely different risks, depending on the companies that they contain. Understanding what is inside the basket is one of the most important steps in building a thoughtful portfolio.